The intraday sell-off initially, was the tariffs, do you think, and why have we rallied back?
I think that the tariff news, when it first hits, there's a knee-jerk reaction, but we've seen this so many times over the last few weeks. I think the market has learned to shrug it off. The cliche that the market doesn't react to the same news the same way is certainly in play here. And then you look at the other information out there in the market that, economic growth is very solid. The industrial production numbers today, once you dig into them a little bit, showed that things are just fine, confirming the retail sales earlier in the week. And so the market can look past that and look towards, positive returns going forward.
Dave, the last couple days with the way the dollar's been moving and now the market's kind of wobbly, is it the trade issues? Is it kind of going back to the Fed? Sometimes it takes a few days to digest everything that they've told us after they raise rates and, have one of these meetings.
Yeah, Kelly, I mean, we've been I think the last piece I wrote on trade was called fade trade. I think you fade trade in general, and today was another fade trade move. So I really think this is all about negotiating tactics. Most people know that. The market gets it. The press sometimes likes to make a bigger deal out of it than it is. But I think
Dave, let me just stop you there for a quick second, because our guest just at the top of the hour said, well, the lid on the market is the trades. If it weren't for the geopolitical trade stuff, that stocks would be shooting higher and everything else looks great. And do you think there's some, you think that's true?
I don't. I mean, I think the market really struggled this year because rate expectations changed. I mean, 10-year note yields went up 50 basis points, and while earnings expectations were going higher based on lower taxes and deregulation, you started discounting them at a higher rate. And the markets kind of seemed to find a little bit of solace that we may be nearer to finding the equilibrium rate at a more pleasant level than maybe what some people were worried about back in February and March. But I think that's really what weighed on the market at the start of the year, and we're still learning a little bit about the rates. I think this week was mostly a learning exercise about Jay Powell, a little bit about the ECB, but mostly about Jay Powell, and he put on a fantastic show. I think he came across with a expectedly hawkish message that they're going to keep going at a gradual pace. But if you dug underneath a lot of his comments, there's a lot of dovishness there. There's a lot of belief that we have not, we've not declared victory on hitting the inflation target, that they're very glad they did not listen to a lot of people who wanted them to move faster. Just a lot of statements that really suggested to me this is not a Fed that's in a hurry, and this is a Fed that sees an equilibrium rate structure that's probably going to be a heck of a lot lower than equilibrium rate structures we've seen in the past.
Ed, we've seen the consumer stocks perform very well again this week. Can that continue?
Well, they're certainly very oversold.
Oh. To Ed, David, we'll let Ed go ahead there.
Oh, I'm sorry, I didn't know.
The consumer stocks and really all the higher dividend yielding sectors have gotten crushed this year as rates spiked. But moving forward, they can have a rebound. But I think the big problem for those stocks is that they were bought so much over the past several years as a substitute for bonds. And so even if the 10-year settles into a range, there's going to be a lot of money flowing out of those into the fixed income space. So that's really the one segment of the market we'd be focused on getting out of. You'd want to be focused on the growth names and also maybe some more cyclical ones. But those defensive high dividend yielding areas like staples are places you'd want to avoid.
And finally, Dave, if you're right that the underlying message was actually kind of dovish from the Fed this week, then what does that mean for where investors should be in this market?
Well, I think, a lot of it is going to depend on, how we settle these rates, Kelly. And the market's had a pretty good week in terms of rates. The bond market's rallied a decent amount, not a ton, but it's definitely been a stable response. We've seen more flattening, so the long end looks very, very secure. And I think that's going to ultimately feed back into this idea that, you just discount these earnings at a lower rate, and earnings expectations next year, consensus is at 165. With the lower rates, I think you got to put multiples up, and I wouldn't be surprised if this market could take multiples up well north of 18, 19, or even 20, and that's a north of 3,000 S&P for me.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.